That was the founder of Enron, one of the biggest American companies at its peak. What is Enron? In this class, we'll be evaluating the impact of fraud using a single organization as a case study. At its peak, Enron was one of the biggest companies in the United States. In fact, one of the top Fortune 10 companies in the United States. When we say Fortune 10, when we say Fortune 100, we are saying the biggest, the most capitalized companies, the 10 most capitalized companies. When we say Fortune 10, when we say Fortune 100, the 100 most capitalized companies. When we say Fortune 500, the same thing applies. So at its peak, there was even a time the capitalization of Enron during its time was the highest in the United States of America. So we are talking about the Googles of these days. We are talking about the Microsoft of these days. That was Enron at its time. So what really happened? What went down with Enron? Enron was an American energy, commodity, and service company. As you'll be seeing in a video that you'll be watching shortly, that will be detailing the intricacies of the background of Enron, what really went down, the implications of what went down, and so much. The market capitalization of Enron at its peak was about $60 billion. We are talking about many years ago, more than 20 years ago. So you can imagine what $60 billion was then. So what really happened? In short, because you will still be hearing and be seeing this in the video you'll be watching shortly, Enron engaged in overstating revenue using a concept that was coined. We call it mark-to-market concept. Mark-to-market accounting is an fraudulent accounting concept where you can recognize revenue before they are earned. You know, in accounting, you recognize revenue as soon as they are earned, not received. But mark-to-market accounting goes a level higher, that you can, even before they are earned, maybe a contract you just bidded for, you've estimated that this is our profit from it, or this is the revenue from this contract, and you recognized it in the book, even when the contract has not sailed through. That is against the normal accounting principles. Then they were understating liabilities by pushing their debt profiles to side companies. Maybe they had 10 billion naira accumulated debt profile in both long-term and short-term debts. They never disclosed majority of these debt profiles on their books. They just set side companies that they were using. They pushed through whatever means this these debt profiles to the side companies. So it never appeared on their own books. So under which type of fraud can we categorize this? This is financial statement fraud. Financial statement fraud. You know, we mentioned misappropriation of assets, we mentioned corruption, and we mentioned financial statement fraud. The third on the list, which was financial statement fraud, that we mentioned in earlier class, was what Enron really engaged in. It was a typical example of a corporate fraud. We're not talking about an employee looting now. We're not talking about an employee misappropriating the asset now. We're talking about financial statement fraud, which is a typical example of what? Of a corporate fraud. That is, the management is, although working for the organization, but they were fraudulent. They were fraudulent. So what was the result? The result was fictitious rising stock prices that plummeted faster. That is, by the time people saw these results, people were estimating that this company can be 10 times bigger itself in the next few years. So the stock started rising because there was demand. Everybody that knows what about stock market wanted to invest in Enron. So, if you were to be an investment advisor, what would you have done? What if a client came to you asking for advice about Enron, as at this time that Enron was doing so very well on the books, but fundamentally they were close to bankruptcy? What would you have done? What would you have done? Honestly, there was no way to know that Enron was fraudulent. There was no way to know, have insider information that Enron was cooking their books. As an advisor, you would have advised your client like, oh, if you know anything about stock, going by my experience, those would be the terms you would have used. In my opinion, I think Enron is the best, what's it called, to be the best company to be on your portfolio of investments now, as will be seen in the video. A typical example of what an investment advisor would have said, or the opinion an advisor, or the what's it called, So if you were to be an investment advisor, if a client approached you for an advice on Enron, what would you have said? What would your opinion have been? As at the time when Enron was doing so well on the books, but fundamentally they were nowhere to be found. They were close to bankruptcy. Honestly, there was no way to know that Enron was cooking their books. As an outsider, there was no telling. There was no way to know or have an insider insight as an investment advisor as to what was going on from the insider's perspective. So I guess your advice and opinion to your investors, to your clients who seek or who sought investment advice could have gone like this. So, what were the implications of all this? What resulted? All investment lost. All investment lost. Every single one of it. All investments. Everybody that had anything to do with Enron lost their money. Everything. I'm not talking about losing half. I'm not talking about the 2009 kind of stock market crash that people lost a lot and all that. I'm talking about everything because the company went bankrupt. So we are talking about $60 billion worth of investment and capitalization went down the drain as a result of fraud. Job lost. At its peak, Enron had more than 20,000, about 21,000 people on their payroll, direct employee, and all these people were rendered jobless. It didn't end there. Even the employee didn't just lose their jobs. The ad pension fund lost because there's something called pension bond, where you can use your pension to buy bond. I mean, you can use your pension, you can invest your pension, so to say. Let me put it in a simple way. You can invest, you can tie up your pension fund in the stock of the company where you're working. So they lost even their life pension entitlements worth more than $2 billion. Estimated individuals affected multi-million, because we're talking about people affected directly like the employees. We're talking about people who are affected indirectly like their suppliers, their creditors, the dependents of all these people that are working with them. Do you know the chains globally? We're talking about institutions, pension funds, equity funds, investment companies in other countries that invested heavily in them. So it wasn't just about people who invested directly in them. We're talking about the multi-millions of people. So it was really a big blow. It was really a big blow. And that's what fraud does. You can never estimate the multiplier effect of a single fraud act. We are talking about a single organization now, and it shook both the financial sector, the risk sector, and even so many other sectors that had anything to do with this directly or indirectly. That is fraud for you. But don't let us forget something. that Enron had an auditor. I'm talking about external auditor, who was saddled with responsibility of ensuring that such things didn't happen, like cooking books. Like, this was just too much. It wasn't like they hid one thing here and there, just few figures and there, but it was just a whole mess. So what happened? Arthur Addison was the auditor of Enron, a big company. We had five big auditing firm. We used to call them the five bigs then. But then, what did Arthur Anderson did? They didn't do their work at all. They were negligent, they were corrupt as well, they were roped in, and they lost themselves in this whole scandal. So they didn't survive it. They didn't survive it. And that is pointing us as auditors, as fraud examiners, as forensic accountants, to the fact that there is a role auditor has to play. There is a role. There is a reason why auditors are, by law, each company has an auditor that has to look into the books of that company so that such things like this don't occur. So when you neglect your role, when you allow yourself to be negatively influenced, these are the results. Because of this single client, Arthur Anderson went down. They went down. Other people, the other four took up their clients. They took up their clients. So that is the implication to the auditors. And it didn't just end there. There are always, where there are established cases of fraud, like we've mentioned, there are always implications to the perpetrator. There were convictions. The executives at least two members of the executives were convicted. One even died during the process of hearing. The other is said to be released, or maybe has been released finally. So that is fraud for you. Fraud does not end well. And as auditors, as fraud examiners, as forensic accountants, we should always, at the back of our mind, has it that we can't be compromised. We can't be compromised. They can go well for the first few years or even more, or for more than a decade or more, but at the end of the day, it doesn't end well. In the next class, we'll be looking at a case study of a Nigeria small SME, the impact of fraud on a Nigeria SME. Like I said previously, that will be when we look at an international case study, when we take an international organization as a case study, we will come back home, either to Nigeria, to Africa, to look at another company, so that we will be able to level this and apply this to our local environment.